Stocks can seem confusing at first. Prices are moving every second. People are constantly talking about buying and selling, and it feels like there's a lot going on behind the scenes that no one explains clearly. You might even feel like you're late, like everyone else already understands this except you. But the truth is, the stock market is built on a few simple ideas. Once you understand those, everything else becomes much easier to follow. So let's break this down step by step in a way that actually makes sense. Stock. A stock represents ownership in a company. When a company wants to grow, expand, or invest in new ideas, it often needs money. Instead of borrowing all that money, it can decide to sell pieces of itself to the public. These pieces are called stocks. So when you buy a stock, you're not just buying something abstract, you're buying a real piece of a real business. That means your investment is tied to the company's performance. If the company grows, earns more money, and becomes more valuable, your stock can increase in value. If the company struggles, loses money, or faces problems, your stock can decrease in value. This is why people say investing is about believing in a company's future. You're essentially saying, I think this business will do well over time. It's also important to understand that stocks trade on exchanges, where buyers and sellers meet. The price you see isn't random, it's the result of what people are willing to pay at that moment. So the value of a stock is constantly being updated based on supply and demand. Share. Now that ownership is broken down into smaller units called shares. A share is simply one unit of ownership in a company. Instead of selling the entire company as one piece, it's divided into millions or even billions of shares. This makes it possible for everyday people to invest, even with small amounts of money. Think of it like this. If a company is divided into 1 million shares and you own 1,000 of those shares, you own a small percentage of that company. The more shares you own, the larger your ownership stake. But even owning just one share still means you are technically a part owner. Shares are also what you actually buy and sell in the market. When you place a trade, you're choosing how many shares you want and at what price. The flexibility of shares is what allows the stock market to function smoothly, because ownership can be easily transferred between people. Bull market. A bull market is when stock prices are generally rising over a period of time. This doesn't mean every single stock is going up every day, but overall, the trend is upward. During a bull market, confidence is high. Investors believe the future looks good, companies are performing well, and more money is flowing into the market. You'll often see strong economic growth during these periods. Businesses are expanding, hiring more employees, and generating higher profits. As a result, more people want to invest, which pushes prices even higher. This creates a cycle of optimism where rising prices attract more buyers. However, it's important to understand that bull markets can also make people overconfident. When prices keep going up, some investors start to believe they can't lose, which can lead to risky decisions. So while bull markets feel great, they still require discipline and awareness. Bear market. A bear market is when prices are generally falling over time. This is usually defined as a drop of around 20% or more from recent highs. During a bear market, sentiment changes. Instead of optimism, there's fear and uncertainty. Investors may worry about the economy, company earnings, or global events, and many start selling their stocks. This selling pressure pushes prices down further, which can cause even more people to panic and sell. That's why bear markets can feel intense. They often move faster and feel more emotional than bull markets. But here's something important that a lot of beginners don't realize. Bear markets are a normal and necessary part of the market cycle. They can reset valuations, create opportunities, and allow long-term investors to buy stocks at lower prices. Understanding this helps you avoid making emotional decisions when the market drops. Dividends are payments that some companies make to their shareholders. When a company earns a profit, it has a choice. It can reinvest that money back into the business, or it can distribute some of it to shareholders as a reward. That distribution is called a dividend. Dividends are usually paid on a regular schedule, like quarterly. So if you own shares in a company that pays dividends, you might receive consistent payments over time. This is one reason why some investors focus on dividend-paying stocks. They can provide a steady stream of income. However, not all companies pay dividends. Many fast-growing companies choose to reinvest their profits to expand even faster. So dividends are not guaranteed, but when they exist, they can be a powerful benefit of owning stocks. portfolio. Your portfolio is the collection of all your investments. Every stock you own, every share you've purchased, all of it together makes up your portfolio. This is important because investing isn't just about picking one stock. It's about managing a group of investments. One key idea here is diversification. Instead of putting all your money into one company, many investors spread their money across multiple stocks, industries, or even different types of assets. This helps reduce risk. If one investment performs poorly, others may perform better and balance things out. Your portfolio also reflects your strategy. Some people focus on growth, others focus on income, and some aim for a mix of both. Over time, managing your portfolio becomes about adjusting your investments based on your goals and risk tolerance. Market cap. Market cap, short for market capitalization, is a way to measure the total value of a company. It's calculated by multiplying the price of one share by the total number of shares available. This gives you a quick estimate of how big the company is in the market. Companies are often grouped into categories based on market cap. Large cap companies are typically well established and more stable. Mid cap companies are in a growth phase, and small cap companies are smaller, often newer, and can be more volatile. Understanding market cap helps you compare companies and understand what kind of investment you're looking at. Bigger doesn't always mean better, but it usually means less risk compared to smaller companies that may still be developing. Volatility. Volatility measures how much a stock's price moves over time. If a stock's price jumps up and down quickly and frequently, it's considered highly volatile. If it moves slowly and steadily, it has low volatility. Volatility is important because it directly affects how an investment feels. High volatility can create big opportunities for gains, but it also comes with higher risk and emotional stress. Prices can swing quickly, and if you're not prepared, it's easy to panic. Low volatility investments tend to be more stable, but they may not grow as quickly, so there's always a trade-off between risk and potential reward. Understanding volatility helps you choose investments that match your comfort level and long-term goals. When you put all of these concepts together, the stock market becomes much clearer. You buy shares of a stock, which means you own part of a company. Those shares go into your portfolio. The market moves through bull and bear phases, creating opportunities and challenges. Some companies reward you with dividends. Market cap helps you understand the size of a company, and volatility helps you understand how its price behaves. And once you understand all of this, you're no longer just guessing. You're actually thinking like an investor. So now you understand the basics of stocks, not the complicated version, the version that actually makes sense. And once you understand this, you're already ahead of most people, because most people don't lose money from being unlucky. They lose money from not understanding what they're doing. But now you do. If you want more videos where things are broken down simply and actually explained, subscribe, because this is just the beginning. Mr. Reality Explained.